Well, good afternoon, everybody. Welcome, investors, to the June 7th, 2022 edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula and Len Douglass. Good afternoon, gentlemen.
Good afternoon, Mark. Glad to be with you this evening.
Glad to also be a participant, Mark.
And is the weather behaving on the south side of Detroit, Len?
Yeah, it was raining this morning, but
looks like it's shaping up out there. All right, so we're going to continue our discussion here, homing in on the electric range, our third session. Talk a little bit about the tequila flameout, but most significantly, going to talk a little bit about the Dallas convention that's coming up in a few minutes. Give a few hors d'oeuvres, few minutes. I guess it is a few minutes, few days. The Dallas convention for the National Association of Investors is June 23rd through the 26th, I believe, thereabouts. And so we'll give you a couple appetizers for that and kind of kick a few things off. We've been talking about electric vehicles for the last several weeks. Len is going to take us back into the topic, again coming at it from the standpoint of we can't see any way for this to virtually happen overnight or like with the snap of a finger. And that being the case, what type of opportunities are out there to invest in the energy sector? And again, it's not going away anytime soon. And we do want to focus on that, as well as the stuff, as Matt Spielman shared with us last week, the notion of using Borg-Warner to play both sides of the outcome, because they are pretty well represented in traditional internal combustion engine components, and they also have developed a fairly strong arsenal of electric vehicle components also. So that's just an example of a theme that can be looked at as an investor. I do want to talk briefly about my own personal effort to convert what used to be a monthly newsletter into more of a weekly, and we'll spend some time looking at that. Len wants to remind us that those barrels of oil we hear so much about are not just gasoline. There's other stuff involved. And a quick update on the tequila trade. By the way, you guys will all enjoy this. My wife actually came down and she caught wind of what I was doing in one of our brokerage accounts, and she called me a traitor. Not a Trader. You're going to love this, Ken. A Traitor, a traitor. And she's like, you realize that makes you one of them? And I said, well, we're just tinkering around a little bit, but
strong language, Wendy.
Very, very strong language.
Before you move the slide, Mark, I think one of the most important things that Matt said last week was that to the automobile industry, 2 or 3 years is tomorrow. My sister worked in the automobile industry for about 35 years, and she was only too happy to second that motion that anybody that thinks that the auto industry, when it's looking 3 years out, is looking far into the future, is really going to be disappointed. It is tomorrow for those people, and what they're doing today is what they expect to have changed in 2.5, 3 years, not what is going to necessarily be something that's revolutionary, but it's where they expect to be in 2.5, 3 years. It takes a long time to imagine, to engineer, to retool, and then finally to manufacture something as complicated as a vehicle.
Yeah,
I was don't forget to certify it to the government that it meets all applicable standards.
An important component, right?
And you can't do that until you've done all the other things.
Right.
Yeah, I listened to my wife attempting to speak French now that Chrysler is Peugeot, Stellantis, but I hear her talking about budgets for 2026, 2027 today. So, I mean, yeah, that's all very much the case.
At Ford, when I was there, the standard cycle plan was a 5-year game plan.
Absolutely. All right.
And that was not necessarily for a new vehicle.
Yeah, we have Michael in our audience just putting the stamp of approval on what we're saying, Mark, that the auto industry is right now finishing up work that will go into production in 3 years. It's just, it has a really long lead time, and I'm not sure that our political structure grasps that lead time. Especially our politicians whose lead time seems to be only till the next election. So that's as political as I'm going to get today, I think. All right.
Those wonderful 2-year cycles known as
Yeah.
the House of Representatives. All right.
Yeah.
I'll stay away from the politics too. All right. You guys know the drill. No investment recommendation is intended. Everything here is about education, demonstration, and illustration. We are literally here trying to take and share our interpretations of 8 decades of techniques, methods, philosophies, analysis approaches that have led to success for a fairly large community of investors known as the modern investment club movement. So we are basically trying to capture those lessons, in some cases remind, and benefit as a community of investors from doing that. Please do your own homework as we talk about any of these and when you make your own decision. We'll try to remember to talk about stuff that's in our own portfolios, but you know what, Ken? Every time I read that, I'm just struck by the meaninglessness of it. It's kind of like answering the question at the airport, do you have a bomb in your luggage? I'm about ready to wipe that out, because what difference in the world does it make if I own 10 shares of McDonald's and then talk about it?
Well, I think if you own 10 shares, it doesn't make any difference at all. I think that this is lawyer language, trying to cover all bases at all times for all people, and it comes across as being a little bit self-serving many times. Maybe if you own 10 million shares or a couple billion shares, that might make a real difference, Mark.
Yeah, there's only been one time in my career where this topic made sense, and that was when Better Investing Magazine was reaching over 450,000 people. And if we picked a small cap or a micro cap for the magazine, it was conceivable that if you front ran it, that means buy it before you publish the news about it, the analysis, that you could have benefited from that. But that really is the only thing that has ever made sense to me over the last 20, 25 years when it comes to that type of a topic. So I don't know. At some point, I'm just going to blow that sentence up and ask.
I think it's interesting to know when you own something or when I own something. The audience a lot of times likes to know that we have a stake in some things that we talk about, but I don't think it's materially makes any difference at all as to what the opinions are about it.
All right. Dismounting soapbox. We do a monthly roundtable webcast where we share 4 ideas. Sometimes we own those ideas personally. And if you'd like to be added to that reminder list, nkavula1@comcast.net is the email address where you can make that request. If you have any follow-up questions for today's session or for like copies of the slides, my email address is the first one, Ken's is the second one. So we welcome suggestions for future topics, and we love hearing from you guys. All right. Just real quickly, going over the best small companies, we continue to actually do fairly well. Our traditional effort is shown by that maroon bar on the left. That is to pick 20 companies and hold them from Halloween to Halloween and do not change the portfolio. It's completely buy and hold. And that one has been lagging a little bit. We did this year introduce the concept of an active version of that where we sold a couple of them, Green Tree and eHealth, and replaced them with companies like First Foundation and Pachura. And man, are we glad we did. That's the difference between the blue bar and the red bar. We continue to trail the market, although we have caught up a little bit, knocking on wood. And we included the Russell 2000 Growth ETF just to demonstrate how tough the field of opportunity, how big the challenge has been at this current time. That's why the bear is still there. The bear will be there until the Russell 2000 Growth fund is actually above 1,600. But that's just showing you in the area where we do the most shopping, the smaller growth companies with higher growth rates has actually been one of the more challenged areas of the marketplace for the last several months. So anything that you want to throw in?
Yeah, the only thing, Mark, I got a note from somebody about a week ago, maybe a week and a half even ago, asking me if all of our picks were part of the Russell 2000, and I frankly didn't take the time to verify whether they were or they weren't, but I know the vast majority are part of the Russell 2000. That's all I can say about that.
We can tackle that next week. I suspect that maybe Boston Beer, Metafast, there's a couple there that, by virtue of their cap size, not their growth rate, to actually skip out of there. Don't know, but we can take a look and answer that question in detail. All right, so pressing on, here's our Groundhog update. Just a quick update to show that a couple of celebrities continue at the top of the chart, and they're not named Warren Buffett. Herb is still in the number one individual slot, closely followed by Sean. And the number one group right now is the North Texas Model Club. There's a number of groups on the chart. And you will notice that this week's highlight is that I dipped all the way down to number 46 for obvious reasons, to catch those two guys at the bottom. So everybody's been doing better. We're still not where we want to be. And it's just absolutely unbelievable to me, but Kathy Wood has slipped into last place.
I will say, Mark, that that's a movement from the 90s up to 46 for Cy, and a movement in the 80s for me up to 45. So both of us have been on a little bit of a tear in the last 3 or 4 weeks.
Yep. So a number of you out there, and this would include me, say it ain't over till it's over, and it runs until next February 2nd, and anything could still happen. But those are the current leaders.
Well, I think number 28 is going to have a lot of bragging rights if that holds, Mark. You know that?
Oh, he's already irritating. All right. Quick look at the market as we take a look at it very frequently, almost every week here lately. That little bump up in the market actually bumped the green bar slightly nudging above the blue bar. I'm not sure I expect that to continue. But the fascinating thing is there was enough downward adjustments in all of the forecasts here lately to push the value line number down almost 2 percentage points in the forecast. So I think that's worthy of a little bit of a collective gulp, because with stock prices falling and return forecasts falling at the same time, that's just not a pleasant situation.
So that number is what, about 12.5, 12.7, something like that, Mark?
I think it's 12.3 or 12.4, but that's down from 14.2 just in a week.
So this glass half full guy will point out that that's still about 2 percentage points higher than an average market.
Yeah, and the value line lag is in there too. So we'll see what they do with their homework this week. It's a noticeable 2 percentage point drop in.
Yep.
And obviously we'll be closing down that quarterly bar here in about 2 weeks. So.
And that's only readjusting 1/13 of the universe, right?
That's true.
Okay.
Well, everything price adjusts, but yeah.
Right.
Fundamentally, you're correct. And here's just kind of a fun view from 35,000 feet that I thought I would throw out there, just as a favorite graph. I think this particular presentation given by Graham Conway at TEDx in San Antonio, it's been a couple years ago, but you can actually access it through that YouTube link down at the bottom. The thing I found fascinating is he covered a lot of the bases that Ken and Matt and Len have mentioned here over the last few weeks about the geographic distribution, the role of the hybrid, the difficulty of getting battery materials, all that kind of stuff, the mode and method of measuring pollution. He really goes into a full frontal assault on this notion of zero emission vehicles. We've actually written several times about how it is just a dislocation or a redistribution of that CO2 production. And he handles that pretty well. And then this graphic, which basically also gives homage to the notion that until you start getting into that 400-mile range, the vast majority of people aren't terribly interested. And I just found this graphic to be quite comprehensive. He doesn't catch all of the nitty-gritty details, but in the span of a 12 or 15-minute TED talk, it's worth paying some attention to. I would also, and then I'll turn it over to you guys for any comments. I would also, I think that watching this one back to back with Michael Schellenberger's, I think very realistic opinions about the full picture, the big picture with renewables, is quite worthwhile. So, your thoughts, guys?
I found this to be one of the most interesting graphs we've put up in a long while, Market. It gives you a lot to think about, and especially from a perspective that I don't know whether I've ever put it in my head before, to start the graphs at different start points based on the materials that go into the vehicle itself. That makes perfect sense now that you mention it, but I'm not quite sure that I ever really put that into my thought process. That white gray bar starts off high because of the components, mainly of the batteries, for the long-term range. Am I missing something, or is that a correct statement?
No, I think Len would agree with that. Len, your thoughts?
It's a question first. The x-axis, does that represent the vehicle life?
Yeah, I think he was coming off of a 180,000 mile average life of a vehicle.
Okay, that's Ford. Our goal 20 years ago when I worked there was to have a vehicle that had a useful life of 150,000 miles. So 180 is very believable.
Yeah, and I do think the theory is, and Matt may have touched on this, that the electric vehicles could actually have a longer period. Now, I don't know about battery life yet, but and I also go ahead.
I had one comment that they used escape hybrids in New York City for taxis, and
Right.
it was not uncommon to have 500,000 miles on one.
Well, that's actually a pretty powerful good thing,
Yeah.
Yeah, and he makes quite a strong case for the urban versus rural consideration, and yeah, it's just definitely worthy. That's why I put it out there, and probably add the Schellenberger to the notes also. So good stuff. I thought it was just a nice comprehensive return. All right, so here's our what's not to like segment of the program. Ken, any thoughts on Cheryl leaving you?
I think she came across, Mark, as pretty sincere, and she made a lot of points that I think that anybody looking to move away from a very intense job might use as reasons to move away. Number one, the desire to do something that she's not only good at but passionate about, I think rings a lot of bells in my mind, at least. The ability to do something for the joy of doing it, rather than to do something to work 16 or 18 hours a day to put a profit motive behind something. I'm not so sure that there's anything nefarious going on, or any bad blood between the two of these people, or anything. I just think that it was time for her to move on, to do something different, and she had something all lined up, ready to go to make it happen.
Well, I agree, and I believe she also has relatively small children.
Yes, she does.
That's certainly a worthy factor also.
Yeah, and there was some discussion she was getting married.
She is. She lost her first husband, and she is in the process of getting married a second time now. Yes.
Okay, I hadn't heard that, but anyhow, it would appear that a nation of investors basically agrees with what you just said. The stock price has been relatively undisturbed other than the disturbance that happened in the first part of February. And so there's been no visible strong reaction to that announcement, at least from my perspective. And then what I thought we would do is talk for just a moment, Ken, talking about our rule of 5 selling criteria that we sometimes seem to stumble over during the roundtables, and how we've laid that out there as kind of a guideline for, in my opinion, a timeout and a full assessment of the company in question. And I think, again, this is another shot at what's not to like statement from, was it January or was it last May?
It was February. Yeah.
Okay.
Well, it might have been the January roundtable. Yeah.
January roundtable. And, I look at this company and there's a lot to like. There's very little not to like. The only thing that gives me a tiny bit of heartburn is that downward trend in percent net margin. Just a little, that's just a little slippage. I think that's natural maturity in some cases and the competitive field, but there's a lot to like here.
Well, and Mark, what I think that maybe I didn't enunciate clearly enough when we were talking at the last roundtable about our rule of 5 is that I think the only thing our rule of 5 rule fails to recognize sometimes is when the market gets a stock wrong to the upside and then corrects itself. I'm not sure that the company changed all that much, and maybe that correction in and of itself is enough for us to back away and take another look at it. But I agree with you. I just don't see enough problem with Meta right now to reevaluate it, to sell it, and then to turn around and buy it back again.
Yeah, and I do think that we have to factor in this number into how we think about that percentage also. I think that you're getting at this earlier when we talked about this. If you're dealing with a below average company and you see this type of price behavior, you probably think about that a little bit differently, or should. That's just my instinct.
Well, I'm committing to this concept of prove as a validator of my par values. And when I see a par value of 28.6 and a proof value of 29.9, I'm pretty confident that our analysis has held up as well as any set of future-looking numbers can hold up. There's nothing ever going to tell us we do it right 100% of the time. But when this proof value that we've been putting to a lot of different tests and gathering much more data on, when it comes down and sits right on top of a judiciously prepared SSG with a par value, I'm saying to myself, I'm going to buy it and move on.
Yeah, like I said, there's a lot to like here. I think if you're really focused on 2021 and beyond, you might make a case for dropping the sales growth forecast by a couple percentage points. You can probably make a case for even trimming a little bit here, but even when you do that, you end up with a robust return forecast.
Absolutely, and when you consider the size of the company, you say to yourself, I'd be happy with a par value of 16 or 15 or 14% coming from a company this size. And to project a 28% par, is just outstanding, I think. So I'm ready to give it a little bit more leeway. If I had the discipline, and I know it's easy to say, well, sell it today and buy it back in 31 days. Well, that assumes that cash that you generated is still sitting there in 31 days. I sit in investment clubs where they can't keep 2 nickels in the cash account because they want to stay, quote, fully invested, unquote. And the discipline to sell something and then buy it back 31 days later. If you have it, then of course maybe you grab that short-term capital loss if it's been generated. But if you don't have a significant capital loss, then why are you messing with it in the first place?
Yeah, I think it's a
My opinion. My opinion.
That's a topic we can dig into in much greater detail. I just wanted to alert the audience to the fact that we are continuing to scratch our heads and try to refine our articulation of our thoughts here. And while we were doing that, my phone just told me that our Delix is up 10%. So my phone never used to do that, but those that would care about that sort of thing. All right, I just want to spend a moment just reminding and just sharing some thoughts on this. What I'm basically thinking of doing and tinkering with is a more regular feature on the expected returns as part of the weekly updates. And those of you that are not familiar with us doing this, I actually had 2 emails this week basically screaming and gushing and quite thrilled over the fact that they had just figured out that we basically provide company analysis and informational updates. Anytime you see these bolded up, you click on that link and you go to these companies, including Matt's Borg Warner, which was just added to the roundtable last week. So Mike Rowe is there for the sheer reason that we have one job here, and that one job is to share actionable ideas for study, and basically to diligently and vigilantly track the investments that our community is interested in, and that's what we're trying to do here. The other email was about they didn't have any idea that we were actually publishing these links, and in this one in particular, they had gone and listened to the Freakonomics electric car discussion from the 1890s, and they were just thrilled. So I actually received a number of emails along those lines. So there's a reminder that there'll be a couple articles that were shared by Len that will make this list in next week's update, and it's just something that we like to do and share, and we're going to be expanding that out and be out with some interesting stuff on screening here shortly also. So
maybe we need a tab all by itself that just says useful links, Mark.
Yeah, maybe I do change it to that, or
Yep.
subtitle it or something.
Yep.
All right. So with that, just a quick moment before we launch Len into his soapbox on the energy sector. There's JR back from the early 1980s? I think so. From the TV show. Just wanted to share a couple of slides. This one I think the audience will find most interesting because most of you are familiar with the fact that we have been doing what Ken was just mentioning. This notion that the projected return on value, as we calculate it, can be used to audit the projected annual return. And in many cases, that leads us to condition our expectations for PE ratios, is what that boils down to. And here's your top 40. Again, it's a busy slide, but the takeaway is that the blue bars are alike the red bars quite often. And where they're not, it's an area where you can dig in and try to understand what the difference might stem from, looking at the calculations. The other thing to point out is the projected returns and the projected return on value for the entire value line universe of 1,300 companies is, for the industrials, is up to date. And you can see that they basically lay on top of each other. So it's a theory that we've had. It seems to be holding true. I'm sure that delta will drift around a little bit, but I would expect it to hold fairly true over the long term. So it really does introduce an element into possibly enhancing and getting a second, third, fourth opinion, however you want to think about it, for our stock studies. Your thoughts, Ken?
Well, I want to make it clear that we're not building bridges with these numbers. We're not coming up with numbers that are going to depend on the safety of something. Rather, what we're doing is we're creating mathematical analysis models. And when you create models, you have to take a little bit of liberty with numerical values. And when I look at 9.8 and 10.1, I see the same number. I know that's very difficult, just as it's very difficult for somebody that majored in English literature to explain to me the variations between the sonnets of Shakespeare. When I tell you that the numbers are the same, I know that's difficult for an English major, a literature major, a history major, or whatever to say, oh yeah, I see the difference, when in fact their mind is screaming, but there's 3/10 difference. But we're not building bridges. I'll come back to that sentence and keep shouting it from the rooftops if we have to. We're building mathematical models, and they rest on different kinds of assumptions about numbers.
And we're not burning any either. If we're building a bridge, we're building it back to where Nicholson was 50 years ago, 60 years ago, when he focused in on the top line of the company and basically their operating profitability. Here's that same type of information, only in this case, it's not just the Manifest 40, it's the value line 1300 industrials. And I would argue that those two are very similar in shape and quite desirable in terms of we want to be shopping, out here for the companies that fit this tab and fit our portfolios. So it's kind of refreshing to see those line up like that, because you may recall when we started with the Greenblatt definition, and by the way, for Dallas, I'm referring to what we do, Ken, as a modified Greenblatt. We were using long-term debt instead of total liabilities, and
right.
It introduced a whole lot of skew into the data. And I happen to think that our decision to rest on total liabilities is the best way to look at the, what a company truly owes. Good stuff. Anything else you want to add here, Ken?
No, I'm just going to sit here and cough, Mark. Okay.
Yeah, don't expire on us.
All right.
All right. Another favorite slide. Just going to throw it up for the purposes of wallowing in a pretty neat experience. Our COVID-1 successful investing conference from now a little over 2 years ago. The case that I make is that one of the best sources of ideas when it comes to screening, I think, is the people around us. And the people at the top of that page have done an excellent job of stock picking. I really like the fact that Pat joined up with Warren to generate this one. And he actually goes through the explanation in it. You can go back to YouTube and actually listen to it, where he talks about this small company that he discovered only because Buffett was sniffing around. So Pat and Warren, being on a first name basis, had a pretty good run there. And we actually talked about the fact that a few of his selections over the years have done extremely well for a few months and then cratered. So he warned us that could be the case here. I think Stone Co. is actually back down either at or below that selection price. I haven't looked lately, but we basically did put in an algorithm to exit that position if it did extremely well, and it did. So good, clean fun, good source of ideas. And notice I was way out in front on the automotive topic 2 years ago. All right. One last slide. Again, one last hors d'oeuvre from the thing, and also a reinforcement as to some of the stuff we're doing with expected returns in the weekly newsletter. We're going to spend a lot of time with this stuff. This happens to be, speaking of Pat Donnelly, there's a reference to Pat again there. This is an up-to-date list of where we basically have selected companies, some of them nearly 7 years ago now, and basically kept track of their annualized return based on a screening criteria. And the one that we used the most by far was the ACE 1 year projections. That's analyst consensus estimates. You can see that one's been used the most for our Fave 5 publications. And it kind of is the answer to that question you keep asking, Ken, how much emphasis or weight do we put on that? And I would argue some, but don't get carried away because it's in the middle of this pack. And there's just a number of fascinating stuff. Some of our favorite topics, the triple play, manifest rank is better companies at better prices. That's what it is. Irish Spring is, of course, Hugh McManus's approach to picking stocks, vetted stocks that are near his 52-week lows. Just some really neat stuff. The fact that most oversold relative strength index as a buy-in point seems to be working out fairly well. And we've published extensively. I'll be spending a fair amount of time in Dallas talking about that. And of course, our recent edition on the banks, ROA, is there. But the other ones that I find more fascinating, we just did a bunch of new Launchpad ones, but this deep discount one is the answer to the question, what if you pick stocks above the sweet spot? You know, those one that are those projected annual returns that are yellowed in for too good to be true or cautionary reasons. Here's the answer to your question. Okay, so just think about that. It says swinging for the fences can be quite dangerous. S&P only has 8 because they've been in the doghouse for 2 years. The volatility of their selections was kind of crazy, and I just got tired of it, so I literally just kind of blew away the column in the spreadsheet. Special situations, I keep this one because I have a number of people who send me highlighted special situations from a variety. I'm not going to name names, from a variety of different institutional publications, and I'm not going to name names. But every time I get them, I mean, I can't ignore this. And it's the old, if you're reading about it or you're seeing it on CNBC, be careful that the bandwagon isn't a distant memory. You know, picking stocks after everybody else is already owning them is a way to make other people wealthy. So anyhow, we're going to go through those in Dallas in one of my sessions, and I'm sure Ken and I will be kicking this around during the two guys session a little bit also in Dallas. Your thoughts, Ken?
Well, Mark, we have one of our listeners wanted to know, can you subscribe to this weekly newsletter?
Well, it's the weekly newsletter that we publish on the forum at Manifest Investing.
Okay, so you can get this weekly information by becoming a member at Manifest Investing then, right?
Right.
So for our attendee that would like to get this information, go to manifestinvesting.com, find out how to get yourself a certain period of free service, and then if you still like it after the free service, do a subscription. It's not that expensive, and I think you're going to find yourself happy that you did.
Okay, so let's keep rolling on. Len is still with us, right? Still out there, Len?
Yeah, I am with you.
Okay, so we're still on this topic of electric vehicles. The one on the left is that electric vehicle from the 1890s, which was raging, the Waverly, which I see the price was $2,900. I haven't calculated what that would be equivalent to, but it had a range of approximately 30 miles and a top speed of 15 miles per hour. And as Matt pointed out last week, you could basically distinguish between the high wealthy people and the lesser wealthy people by whether or not they took the mechanic along with them in the cars of the time frame. So there you go. So electric cars are nothing new. It's a topic which has been raging, and as we've pointed out, we really fear this notion of running out of either gasoline or battery charge is one of the major things. Just a quick reminder, it's a busy slide. I would encourage you to take a look at it. The electric vehicle question is a large, complex topic with all kinds of pluses and minuses in terms of impact on everything from emergency rooms to insurance companies to you name it. And this is a pretty good slide depicting that. That's what we're trying to dig into. Len's going to actually lead us to a couple unexpected destinations as we continue this effort. And then here's just a quick reminder of how cyclical. When you say cyclical, we're talking about top line cyclicality here. The cost of the price per barrel has been definitely very cyclical over the years. And I believe we are back to almost 120 as of today. Are you keeping track of that, Len? Are we back up here?
And hold on a second.
I think I saw 118 on one of the futures.
118 this morning.
Okay.
119.51 according to Market Watch.
So we're definitely back in the twilight zone on the upper end here. So good, clean fun. All right. So with that, I'm going to launch Len into. Sorry about that. I forgot to silence my phone. I'm going to launch Len into a discussion of this is one of his favorite sector ETFs, the energy sector, and you can see that it's actually done quite well while the general stock market has been in quite a pinch here over the last several months. Obviously, the energy sector has been surging quite handsomely. In fact, up to some fairly high momentum indications at this point. So with that, Len.
Okay. Well, let's see. I'm okay. This slide is basically for your information of what do you get out of a 43-gallon barrel of crude oil. You get gasoline, you get diesel, you get jet fuel, you get bunker C for ships and locomotives, you get asphalt, you get plastics, you get the hydrocarbon gas liquids like propane and butane. Crude oil is totally wound into our civilization. So I find it a little bit, I don't want to use the term disingenuous, but baffling when somebody says, oh, well, the oil companies are going to go out of business.
Yeah.
The thing they're going to go out of business when we are living in the forest, wearing furs, and eating cold meals because we don't have fire.
That's not going to happen. My wife's version of camping, favored camping, is called Marriott. What I found fascinating about this, Len, is almost 20% of the volume of a barrel of oil is in non-gasoline stuff. This stuff right down here, headlined by plastics and solvents and paint and synthetic rubber, much of what's shown up here at the top. So, yeah, it's everywhere.
Yeah, let's see. We're going to segue into a discussion, I hope, of the sector exchange traded fund that represents energy, which is the symbol XLE. The best performer of recent couple months has been Occidental Petroleum. Well, there's a number of reasons for that. One is Warren Buffett of Berkshire Hathaway has been buying the stuff like they stopped making it. And you can see truly massive daily volume. This is a end of day Friday. Yeah, it is. Okay. 23 million shares traded hands. There shouldn't be any concern about being able to purchase or sell your position in it.
Yeah, and he actually started buying in the fourth quarter of last year. Is that correct?
Yep.
And then the news on it came out sometime in February, so that accounts for this spike in volume pretty much.
Yeah, well, he was buying like there was no tomorrow in February. One of the reports I've read, the earnings call for Occidental, after listening to the earnings call or reviewing the earnings call, Warren's comment was, the CEO is doing exactly what I would be doing. Back up the truck.
Okay. Yeah, and I basically subjected it to one of our quick analyses. And the thing I want to point out here, again, the cyclicality is obvious on the chart up here. This is sales, and you can see how much it has cycled. Notice that the operating margin doesn't cycle that much. And I think that's one of the things that has Buffett's attention, 50 to 60% and heading to the upside. But the thing that really grabs me, and Ken, I would be interested in your thoughts if you've done any homework on this yet. Why are these numbers so high for these energy companies when you start comparing these two? It can't just all be PE. I just find it fascinating that many of these companies, even after significant gains in price, the prices have gone up substantially, still have these elevated projected return on values. And we've kind of noticed this with Hebner's stuff a couple of weeks ago. And it's one of the things I'm scratching my head over this.
Well, one thing that I noticed, Mark, was that this is not a uniform problem from oil company to oil company,
Right.
and I'm wondering if some of it, maybe a lot of it, has to do with management style and the ability to keep cash in a decent position on your books during leaner times to help even out some of the cyclicality of the whole industry. Now that's by no means any kind of a completed thought, but I think that the inclusion of cash on hand into this proof number certainly plays a large part in some of these differences. I think the PE also plays a large part. I think that the market is hesitant to give highly cyclical companies a high PE, even during periods of extreme movement to the upside on the price. I just think that there's a lot of resistance from people like myself that refuse to trade in these highly cyclical stocks. I don't think that highly cyclical stocks, especially energy stocks, are stocks that are traded by the huge majority of retail investors. I think that that's a much more select group of people that choose to dabble in these kind of stocks. Now, again, I don't have very much to back that up. That's just a thought that comes to mind right now.
Yeah, and
But
one of the
there's
things,
certainly some different things about the model.
yeah, one of the things I was going to point out, in case you're feeling frustrated and alone, if you take a look at Value Line, they're obviously struggling with the analysis of this company. They show it with a negative long-term low total return forecast, and the same is true with Morningstar. So, we know that those type of institutions struggle with early stage companies, but they also struggle mightily with the deeper cyclical companies, and so do we. And so take some comfort in the fact that all of us are uncomfortable, I guess.
Well, and Mark, who's to say? I mean, it gives me the heebie-jeebies. That's a very technical term, but I get chills up and down my spine in just making the assumption that 2023 and 2024 are going to be down years in sales and earnings. Who's to say that that's correct, and that trend doesn't continue in an upward direction for another year or two? I just can't have any good feelings about whether that turn in 2022 is real or it's just wishful.
Yeah, and I think Len probably thinks that the pessimism is coming on a little bit strong. Who knows?
Well, a couple comments. One, when you try and compare this company, and I don't know if they discontinued their dividend during the low year. ExxonMobil, for example, did not. they took on debt to continue to pay their dividend,
Mm-hmm.
and were derided for it. But from a 2020 viewpoint, to be able to buy Exxon, which at the time was trading in the low 30s and paying over a 10% dividend, just thinking about the ability to drip reinvest in that for a couple of years or for the foreseeable future.
You know, I think that encapsulates what you and Kenneth both said about the effectiveness of management in thinking through what type of, cycling challenges lie ahead. So let's go ahead and keep rolling. Well, this is your high five at the water cooler slide, huh?
Yeah. This was the stockcharts.com perf chart for basically the last year, and you have the 9 sectors of the S&P represented by exchange traded funds, and which one is outperforming the others. It's rather obvious, and has been basically since the first of the year.
Yep, been crunching away.
That for me raised the question, what is in XLE? And here's the top 10 holdings. And you'll notice that when this slide was generated, the top 2 holdings by percent of assets were ExxonMobil and Chevron, and represented over almost 44% of the value of the ETF. And other components. We might want to jump to the next slide so we can see this is the full picture of the stocks that are included in the XLE exchange traded fund by their percentage weight. And one of the interesting observations is they're all oil companies. Schlumberger is an oil equipment company. There's 2 marathons on here. One is the exploration company, the other is the refining company. Kinder Morgan, a pipeline company. Halliburton is another equipment company. ONEOK, I believe, is a pipeline company.
Mm-hmm.
Baker Hughes is an equipment company. And then the top pick for energy stocks using manifest investing par and quality, and we're going to look at a picture of it in a minute, is Coterra Energy, which is actually a natural gas company. Just to have some ability to judge, on the 7th of February, I set up a dashboard on manifest investing with the 21 companies and assigning each one $1,000 for a position, just to be able to track it. And I couldn't get a screenshot of it because the manifest keeps updating it. So here's today's, I think this was this morning's update. And it's interesting. Every one of the 21 is over the $1,000 we invested in it when we set up the dashboard. And the average is, let's see, 27 minus 1,000. So 6,888.99. And from February 7th, March, April, May, 4 months. It's interesting, to say the least.
There's not too many things out there in the world of investing that are 20 for 20. This is almost rivaling Kramer's pandemic portfolio from a couple years ago at this point.
Yeah, and
Ken's all his favorites.
now this isn't the universe of energy companies, obviously, but at least it's a fairly broad spectrum that includes ExxonMobil, Chevron. Unfortunately for Hugh, it doesn't include BP. It seems to be focused totally on U.S. companies, which is fine. But investing in XLE versus picking out individual companies certainly gives you a broad exposure to the energy sector of the S&P 500.
Yeah, I think what I want to do is pull down a approved number for each one of those companies and stack them up just to test that head scratching we were doing a few minutes ago. So we'll probably come back to that.
Okay. Well, and here, looking at the right-hand column, look at the symbol that's top in oil and gas exploration and production, Coterra. And then top in energy, still Coterra, with a PAR of 19.9 and a quality of 77. Yeah, it's certainly worth a look.
It's interesting, Len, that the 5 top in energy stocks, look, I don't see any oil companies on that list. So if you're going
EOG.
after, is EOG? I'm looking at the bottom, Mark, where it says top in energy.
Yeah,
Is Boom an oil company?
Boom is not. LPG is obviously gas. PBR is petroleum Brazil.
Yeah.
Okay, so we do have a petro company in
Yeah,
there.
I have bad feelings about PBR. I owned it at one point in time.
That's a company.
I was going to say there wasn't a single petro company there, but evidently there's one there. Okay.
The foreign one.
Okay.
Yep. That's
interesting that there's those 5 there. Yeah. All right. I'm sorry.
Okay. And then I stumbled on a Motley Fool article, which I forwarded to Mark, that raised the company was Darling. Am I remembering the name right?
You are.
Okay.
Ticker's DAR.
If I remember the statistic, they control about 15% of the world's rendering of animal slaughter byproducts, and they have a co-venture with Valero, the refiner, to produce term is escaping me. It's non-crude oil based diesel.
It's basically biofuel.
Biodiesel. Thank you.
Yeah. Yeah, I've actually been to the plant out in western Nebraska. It's probably not one of the highest ranking experiences of my lifetime, visiting that as a field engineer, because there's just a bunch of carcasses being converted into other stuff. It's interesting stuff. Well, the reason I threw this company out there is in that same Motley Fool article that mentions Darling, where you never would have thought you would have ended up. This company actually shows up also, mentioned by the Motley Fool article columnists. And this particular company is involved in the production of things like Milwaukee tools, which I remember my dad thought very fondly of. Ryobi and others. You can see it's not the smallest company, 13 billion in trailing 12-month sales, but there's a lot to like in these pictures on this screen also. So it is an ADR. I'm not even sure where it's headquartered, but the ADR with that ticker symbol TTNDY, it's certainly worth a little bit of a closer look. It's not covered by Value Line. But that looks to me like a management team that knows what they're doing with some fairly highly regarded tools. Any other thoughts?
Hong Kong.
Oh, they're in Hong
Kowloon
Kong?
Commerce Center, 51 Kwai Cheong Road, Tower 2, 29th floor, Hong Kong.
Okay.
And it says the industry is housewares and the sector is consumer goods.
Okay.
Would have thought we got there from an article on energy.
Well, they make a whole lot of stuff that's used on rigs and refineries and production facilities for energy. So that's how they ended up there.
Mark,
Yeah.
could you give our audience the ticker for Coterra again? Did I get that name right?
It's Coterra, yeah, and it's
Coterra.
CTRA. And
Okay.
I actually do have a slide that captures an image of that in the appendix here. We'll stop in on that also.
Okay.
All right. Here's a real quick look at the question Ken proposed last week. I think it was last week. It might have been 2 weeks ago. Just the general challenge and difficulty of successfully investing in Schlumberger, which is a great company, in this realm, oil and gas field services and equipment. And you can see that it's been quite a turbulent ride since the mid 1990s. I left the glory years of the late 1990s in there because this was truly a darling of the better investing community back in that time frame. And you can see that they've had their share of rough moments. You can see that they also are recovering fairly nicely here over the last since the pandemic. And the question that was asked what if we had, instead of trying to pick those entry points over time, just simply invested $100 or $1,000 into it every year? Here's the answer to that question. If you went back 28 years and put the same amount in, no matter what your stock selection guide said, you would end up with an annualized total return since 1994 of 2.4%. And the last 4 years have been glorious. The first couple of years were pretty good, and everything in between has been kind of mixed. So does that answer your question, Ken?
Well, absolutely. And all you have to do now, Mark, is invent a spyglass where I can spy the bottom and spy the top and get in and get out at the right times, and I'm going to make a lot of money.
Well, that's a chronicle coming to you soon.
Okay.
Maybe. All right. And we are running a little bit late, but let's finish up with what we're talking about here. And now for something completely different. Many of you are familiar with my Tequila Trifecta trade. Again, I went looking for a situation where it was oversold so that the projected return is high. The NASDAQ 100 QQQ exchange traded fund fit that bill. I was looking for an oversold condition down around 30. We got that. And the third thing that I really wanted to be different from other instances in the past was high volume. And I got that. So back just shortly after Cinco de Mayo, I believe it was May 12th, actually took an initial position in one of the options affiliated with this TQQQ. This is a completely maniacal trade, by the way, using a leap, a long-term equity appreciation option. But these three conditions were compelling to me. And the headline is, as of today, I sold out of the position. So in a little over 3 weeks, actually generated a 49% return doing this maniacal trade. So that is your update. The reason that I sold, the QQQ projected return has not changed that much from here. We basically have bounced off an RSI of 50 a little bit, which is a little bit disconcerting. But what I'm seeing is waning, declining interest by what would theoretically be the rhinos or the institutional investors. If they go away, that's just not They're not giving me the support that I want. I will probably go back if 1, 2, and 3, if all three of these conditions hit in the future. And again, this is speculation. It's a small part of my trading portfolio. Yes, my wife called me a traitor. Then I advised her that my traitorous activities were actually going to pay for a piece of furniture, and she said, "Oh, do that again." So yeah, I'm not. It was speculation. I think it was decent speculation. None other than Pat Donnelly gave me an attaboy and told me not to be discouraged. But interesting results. So yeah, we keep these things in
Mark,
perspective.
could you back up to that slide once more, the one before that?
Yes, sir.
Where's this quote coming from that you have boxed in at the bottom?
That's actually from Greenblatt. That's actually a Joel Greenblatt. I should have his name on there.
Okay, so is the counter statement to that equally true?
Tell me what the counter statement would say.
There is almost no other area of the stock market where research and careful analysis can be punished as quickly and as severely.
Sort of. The one that really pops out with me would be a standard shorting of a stock. I think you can probably be punished much more extremely, and with just a straight up short position than what we're talking about here. Here, the amount that I put in was less than $2,000, something like that. That was at risk. I get that. With a short position and that same amount of money, I could have been, at risk for 3 to 4 times that amount.
Right, right.
And that can happen pretty quickly with individual stocks, especially cyclical stocks.
So
yeah.
what happens with a leap to punish you? It just doesn't move back up?
Well, the leap. Keep in mind that I'm doing a January 24 call, so it's out there quite a ways. It's not like
You're in
trading
the
next
future,
week's or
right?
the
Right.
clock's not going to run out. I never would hold it that long.
Okay.
And the point to be made, maybe it's something we dig into in much greater detail at a future bull session, maybe dedicate 15, 20 minutes to it. Hugh McManus has done this for a long time and done spectacularly well in a few cases. It's an interesting thing to think about. And I'll just close with pointing out that, when I sat down years ago with the people at Options Express, which is now part of Ameritrade, and I was actually with their head of trading and education, and I basically said, I'm scared to death of options. I don't get it. I really can't. I don't think I will ever be comfortable with the notion of an investment of mine expiring worthless when the clock runs out. I just can't. I can't warm up to that. And his response to me, this is over lunch, his response to me was, Mark, what you don't understand is that there's a lot of people out there basically treating this as a game, almost a video game. And you're sitting there and you understand the underlying, what is the option based on, the actual stock or group of stocks. He says, you actually have that down. So you're actually the one who is dangerous to us. And when I think back to the things I've witnessed Hugh McManus do, I think that's what he's getting at, because these are premeditated and pretty well thought out in Hugh's case, and we could be the ones who are the dangerous ones out there, because we're not treating this like a video game. So anyhow, that for what it's worth, here's a look at what's actually happened over the last month or so. Like I say, I got into it back in mid-May or early May, became an instant genius going up 40 or 50%. And then the market wrecked that and gave me a double dose of humility. So I basically bought another position per Pat Donnelly there, and I have drifted back up to a point where we have a 48 or 49% total return on the entire transaction, again, since May 12th. It's just interesting.
And did you have the ability to jump out of it at that first peak, Mark?
Yes, I
Okay,
had the
so
ability to jump out. I was surprised that I didn't. At the ease of selling.
and what keeps you in it is just the desire for more return.
Yeah, I mean, you could theorize that if I held this for a long term, and rolled over the options, the rewards could be extremely significant, so long as the Nasdaq increases in value.
Okay,
Ultimately, and
okay, thank you.
so one of my other reasons for stepping aside for right now is part of that lesson you've taught me about an oncoming light that could be a train, Ken. And we are only a couple weeks away from the next batch of earnings reports. So, in combination with the expected potential weakness in some of those earnings reports, companies are getting crucified if they come in and report just good earnings results. Not great, just good, and then the stock price goes down 10, 20%. So, I see that as a vulnerability. That, in combination with the declining volume, is the reason that I'm just stepping away. I think it's okay to high five at the water cooler. My wife says I don't have to sleep on the couch. I'll take that as a win. All right.
Well, I'm going to leave everybody, Mark, with my favorite uh, indicator, and that's called the Better Homes and Gardens indicator. And when you see your stocks being discussed in Better Homes and Gardens, that's a time to run for the hills, okay? I've noticed in Better Homes and Gardens twice now in
Oh
the
no.
last 6 months that they've talked about housing. They haven't talked about any housing stocks yet, but they are talking a little bit about housing. So I'm carefully watching Better Homes and Gardens, and the first time they mention D.R. Horton or Lennar or something like that, I'm out of housing stocks immediately.
All
Okay.
right. We will put that. That is a very reliable indicator. We'll put it on the list.
We'll watch it. All
We'll
right.
be watching it carefully on behalf of all of you out there. All right. In that spirit, we do put all of these sessions on YouTube under the Manifest Investing channel. If you have trouble finding it, send me a note. We would love for you to subscribe. I would love to get us to 1,000 where we can actually have some fun at some potential wider exposure. I think what we do here with the Modern Investment Club movement is powerful. I would like more people to know about it. I hope you all feel that way too. So subscribe. Just keep in mind that we do put archived recordings of all of these bull sessions, all of our roundtables, any educational sessions. Ken and I had one heck of a great time with the mid-cap, medium-sized companies in our portfolio shown here celebrating workhorses. It was actually part of this roundtable co-sponsored by the St. Louis chapter of Better Investing, and just a great time. But those are all there, just so you know it. Sean is tinkering with shorts, having some fun with these. We're going to continue to keep doing that experiment also. And of course, there's the question. I'm running with the rhinos now, skeptical about what might happen over the next few weeks with the NASDAQ. And I don't know the answer to that question. I don't think anybody does. But Goldman Sachs has come out at least 3 times in the last 6 weeks and said this is it. So 2 weeks from now, we'll get it again for the 4th time. All right. And one last slide, just a really quick one to show you the company that Len has brought to your attention, Coterra Energy. Again, cyclicality there for sure, but it's compelling. It's a small, extremely small energy company, but with some compelling characteristics to at least be aware of who they are and what they do. All right. Any last thoughts, Ken or Len?
No, Mark. Good session. Good session, Len.
Yeah, I was going to, sorry, I was muted. I was going to add that when you start deep diving Coterra, you find they have both a natural gas play in the Appalachian region and also in the Permian in Texas.
Ooh, okay. Yeah. There's some interesting characteristics there also, and of course, cyclicality is obviously going to be part of their life. So how they manage it is that ultimate
Yeah.
question. We'll dig in a little bit deeper into that area as we continue to scratch our heads. All right, so with that, I'll go ahead and sign off. Thanks,
Okay.
investors. Good hunting out there. Let us know if you find anything compelling or intriguing. Thanks,
Good
everybody.
afternoon, everybody.
Participate.
Thanks for coming.
Thank you, Len. Solid contribution.